Cool.
Good afternoon, good morning, good evening, wherever you are on this big round planet. Very quickly, doing a quick interview here with my very good friend of 24 years, Owen O'Malley.
Yeah.
Myself and Owen have been on a fantastic personal development journey back in the early years, where we spent a lot of time working on our mindset, or our mind flow, as I like to call it. And started then to look at different ways to improve our skill sets. So I want to talk about a skill set here in a moment that Owen is going to bring to the table. Owen is an expert in the stock market, and he spent a lot of time developing these skills over the last 20 odd years. We spent, both myself and Owen spent a lot of time at various seminars, from the likes of Tony Robbins to Joe Dispenza. You name the gurus that are out there. We've been to a lot of these events. Owen has actually shared the stage with a lot of these people, and he knows his stuff. So I'm going to ask Owen just to speak for a couple of minutes here, and you'll understand then why I recommend that you have a listen to what Owen has to say. This guy knows his stuff, and he walks his talk and delivers. So over to you, Owen.
Thank you very much, Declan. And if anybody wants to know why they should pay close attention to this short video, we know how the richest people in the world become the richest people in the world. Success leaves clues. So that's what I've studied with a passion for over 25 years, since I've done the Tony Robbins Wealth Mastery Seminar, where we had the honor of being taught by 24 of the wealthiest people on the planet, who genuinely did distill their decades of knowledge and experience into days. So let's take a quick look at the interesting study of the richest man in the world, Warren Buffett. So you can see here on the screen here, this is his basic history, his life story, as it were. And Warren Buffett started out at age 11. In 1942, he bought his first 3 shares in the stock market. And by age 14, he was worth $5,000. By age 30, he was worth 1 million. By age about 55, he was worth 1 billion. And today he's worth 80 billion. And all Warren Buffett did is 3 simple things, exactly what we do and what we can teach you to do. All Warren Buffett has ever done his whole life is only ever invested in the strongest companies in the world, number 1. Number 2, he's only ever invested in those strong companies when the share price is very low and they are great value for money. And the third thing that we do that he can't do, because he's managing a fund, is we rent our shares every month. Now, I know you might be curious to say, well, how the hell do you rent your shares? Well, the stock market in New York has been around since 1792. And so for hundreds of years, people have been buying and selling shares. And most people in the world just buy, hold on to their shares, and hope that the shares do well. When you think about it, if you buy a share and it stays the same, you don't make money, because money loses about 2% value every year. And if the share prices go down, you don't make money. Obviously, you only make money if the share price goes up greater than 2% per annum, because that's the basic cost of money. So looking at that equation there's only 1 in 3 chance of success in the stock market if you don't use your shares to generate an income. And so what we do in the stock market is we basically, number 1, we pick the strongest companies. Number 2, we pick them when they're good value. And number 3, we rent them. So let's just jump here to a quick presentation that shows you our system, which has been back tested for over 20 years now, which allows you to be able to understand how we could identify the strongest companies in the world. And so, are you looking, Declan, at a globe with a 4x4 in it?
Not yet. I'm still seeing the slide with net worth of Warren Buffett.
Okay, thank you for that. I'll just do that share now. It should be coming up now.
Yep, got it now.
Perfect. All right. So just one reason why you might want to take a serious look at the stock market. If you had been around in 1928, if you had invested $1,000 in the S&P 500. Now, what is the S&P 500? It is the Premier League of the stock market. Just like there are thousands and thousands of soccer clubs and teams around the world, there's only a few select teams play for the Premier League in the UK, for example. So the likes of Liverpool, Man United, Man City, Tottenham, etc. So the S&P 500 is effectively the Premier League of the stock market. There are about 46,000 companies, but the Premier League is the top 500. If you had just simply bought $1,000 worth of all 500 companies in 1928, today that would be worth 3.8 million. The stock market has done on average 11% return over the last 90 years. So you could be very lazy now and just finish this presentation. Just go ahead and buy a little bit of all of the top 500 companies, and you will do around about 11% per annum. That's why Warren Buffett has instructed his wife to put 90% of his 80 billion in the S&P 500. So that's just the S&P 500. So what I would say to you, Declan, if you know the top 500 companies are going to do the best returns on the planet, why don't you simply look at, well, why don't we find the best 100 of those 500 companies? And that's what we can show you to do. We can show you a simple system to be able to identify the best 100 companies out of those 500. And how long have we been doing this? We've been doing it for 20 years. And in the last 20 years, our selection have done 3 times better than the market. The market has done on average 5%. Our companies have done 15%. So you might say, well, how can you do this? Well, it's simple. You start with 46,000 and you narrow it down to 6,000 using a company called Value Line. The Value Line have been around since 1931, giving us independent factual information that is conservative, reliable, and trustworthy. Warren Buffett and his partner Charlie Munger use Value Line. Carl Icahn, another very famous investor, uses Value Line. Within the Value Line universe of stocks, we narrow it down to the top 300, and then we narrow it down to the top 100. And that's where we pick our companies from. You might say to yourself, well, how can we identify quality companies? Well, we look at 7 things. It must be in a good industry. It must be the right time. It must be safe. Must have little or no debt. It must be volatile, but not too volatile. It must have excellent track record in the past 5 years for sales and profit, and a future 5-year excellent projections. And it must have a great management team. If it scores greater than 40 out of 52, it gets a 4 for quality. 99% of companies will fail this test. Only the best 1% will get through. So we focus on the best 1%. Next thing we take a look at is value. We look at the dividends they pay out, the price they're going to grow in the future, their sales compared to profit. The price divided by profit is a very simple but very powerful measurement of value for money, and the reward to risk ratio. Think of it as property. If you buy a house for 200,000 and you put in tenants and you collect 10,000 a year rent, it takes you 20 years to get your house back. That's a PE ratio of 20. So we look for companies that have PE ratios of around about 10. So again, we give it a score out of 40 out of 52. If it scores greater than 40 out of 52, it scores 4 for quality. So how have our top companies done? Here's our top 10 companies in the last 20 years. Companies that you may have heard of: TK Maxx, Starbucks, maybe NVIDIA, they do the gaming, Shoe Madden, they do shoes. O'Reilly Motors is just like auto fast fit. Dollar Tree is just restaurants. So these companies have done between 700% and 1700% in the last 20 years. So our system is totally back tested over the last 20 years, and you can do your due diligence to check that out. Once you own your shares are a bit like a house. You can rent them. You can buy and sell shares in the stock market since 1792, but options is a relatively new development in the market since 1973. So you buy your shares, you sell your options to generate an income, you use income to buy more shares. Those shares allows you to sell even more options, which allows you to buy more shares. So you use the power of compound interest. It looks a bit like this. There's 4 ways to make money. You buy shares, and if they're good shares, they'll do well long term. While you're holding on to them for the long term, you can collect dividends, reinvest the dividends to buy more shares. You can sell call options and reinvest the call options to buy more shares, and you can sell put options and use that to generate more income. So visually, it looks a bit like this, Declan. You've got your shares, which spin off put income, call income, and dividends. And with those dividends, you can go ahead and buy more shares and start the whole journey again. With the call option income, you buy more shares, start the journey again. And with the puts, you can buy more shares and start the journey again. So you can see that your account will effectively expand over time, even if your share price stays the same. So even if you've got no share growth, because share growth goes up and down all the time, you're still going to do decent return over time. So this is just an example of an account. They put in 100,000. They're after 30 months, they're worth 179,000. So they made 79% in 3 years, almost 3 years. They've collected 25,000 of call income, 132.37 of put income, total income 182, dividends 27. So 100 plus 175 has allowed them to reinvest, to now own $324,000 worth of shares. So that's a simple system. Declan, any questions there?
No, and it's I know you went quite fast there, but in very simple terms, you know, what I know and understand is that you've first of all demystified the stock market, and I even would go as far as saying that you've de-riskified it because of the strategies that you employ. Obviously, with the top companies, the best shares, and when you're selling or selling calls and puts, which people maybe don't fully understand. I suppose the one question I would ask you is, people, when they don't understand this process, can maybe feel that there's a high risk involved here. Could you just cover off the risk element of it, or the
Yeah,
lack of
no,
risk?
I know exactly what you're saying, Declan. I mean, I've been explaining this concept for over 20 years in 50 different countries, 15 different languages through translators. And so many people, when they look at this option thing, it fries their brains and they don't understand how it works. But it's like anything. It's like, remember the time, Declan, when you tried to learn to ride a bicycle, it seemed difficult, but once you had it, you had it. When you tried to learn to swim, it seemed difficult, but once you had it. The same with this skill set here. Once you've got your mind around how options work. So options are simply in New York Stock Exchange, which, as I said, has been around since 1792. You can buy and sell shares all day, every day. But let's say Declan buys a share for $9. Then he declares to the options market he's willing to sell it on for 10 and make a +1 profit if he does that. Well, the options market thinks, some trader in the options market has this thought bubble that says, wow, this share could be worth 12 at the end of the month, and I could buy it off Declan at 12, off Declan at 10 and sell it back to the market at 12, and I can make $2 here. So he's thinking of a possible $2 in the future. And because of that possible $2, Declan, he'll give you 50 cents today. And so if you do this times 18 months, you'll have got your $9 back. So you de-risk the market. So not only do we demystify the market, we de-risk the market. This is exactly the same, Declan, as buying a house for 200,000, putting in tenants, collecting 10 grand a year. 20 years later, the house has paid for itself. So then you're in pure positive cash flow. And that's how most people can retire off their property portfolio, but it takes them 20 or 30 years to get there. Whereas we can show you to do the same thing in 2 or 3 years using the options. So the options is no different to collecting rent from your property. So that's how the options work.
Great stuff. Just on that particular example, Owen, the beauty of this is, obviously you've purchased, the strongest shares that you've actually chosen. When you sell a call there or a put, you're getting your 50 cent. You're basically collecting 50 cent rent per share.
Yeah.
So the thing is, what happens then is it takes that fear away of, obviously you want the share price to go up, but you're collecting an income off your shares here, which most people don't really understand, and that's the power of what you put in place here. It's flipping, it's magical, and when you compound that, it gets even more magical.
Absolutely, that's the power of compound interest. So just to finish up here, I just want to show a club in Dublin there that they just opened up their account with 25,000 euros back in April of last year, April 2019. And you can see here, Declan, you can see on the screen there, they've put in 27,930. So that's the exact amount of dollars that was bought at the time. Can you see that?
Can, yeah.
And if they cashed in now, they're worth 35,000. So if they cashed in now, they're up 27%. They're up 7,600 in 9 months. And here's an example of a company they bought, Pets. It's a veterinary medicine company. They bought it for $22.50, and it's gone up to $26.50, and they've already collected $9.95 of rent along the way. So they've collected already 2,400 of call income, 21,000 of put income, 23,000 of option income, dividends 335, total income 23,000. So 27 plus 23,000 allows them to now buy and own 50 grand's worth of shares. So immediately you can see they're always reinvesting their shares to buy more, reinvesting their income to buy more shares, and then use the shares to generate more income.
Yeah, that's a seriously powerful strategy. Owen, can we just focus on this for 1 minute here now?
Yeah.
If somebody's looking at this, 27 grand. Sorry, just go back to that screen there if you can for a moment.
I'll go back over the top. Yeah, go ahead.
Just where somebody has invested 27,900, that's say 25,000 euro, okay?
Yeah.
So let's stick with the dollar price. So they've invested 27, now it was $28,000 there. They've
Yeah.
made 29% in 9 months.
27%.
Sorry, 27%,
Mm-hmm.
like in 9 months. Like, where are you going to get that with money sitting in any bank account or any other investment out there? That's a serious return. Now, that's not even talking about compounding stuff forward or buying more shares. That's a serious return just on that. And can you just explain to people the process of what can be done for them? Like, when people can look at this here and they see calls and puts and dividends and options drag and stuff, their eyes can glaze over.
Mm-hmm.
But you have a system in place here where you have, obviously, we're looking at two types of people at the moment here. Everybody's looking to get in some sort of involvement within the stock exchange, and minimize risk here. So you're looking at two types of people here. Could you just explain exactly who we're putting
Yeah,
this out to?
most people are not happy with their pension returns or the returns they get on the money in the bank or with the pension. So most people want to know how to do it for themselves. There's a general movement on the planet that more and more people can access the stock market directly, don't need to go through any middlemen, and can take it on themselves. So there are two types of people we have. There are people that want to learn how to do it for themselves, and they typically join an investment club where they put in a small amount every month, and they meet with us once a month for an hour, and the whole focus is to learn how to do it for themselves. And it takes them maybe 1 or 2 years to get there where they can be self-reliant. The other type of client we have is someone out there who's got a lump sum, and they're very, very busy, and they're not inclined to want to learn how to do this, but they're happy to partner up with us. And we have a very simple partnership arrangement, which is the money stays in their control, stays in their account. We help them set the whole thing up, and we meet with them once a month for a short meeting, and we effectively run everything by them, and they have the final say on what happens. And the deal is the first 10% of growth, there's no charge for that. The first 10% of growth is theirs, and anything above 10%, we split 50-50. So if we help them make 12% return for the year, they get 11%, we get 1%. If we help them make 20% return for the year, they make 15, we make 5. So it's a very simple arrangement. So if anybody's out there listening to this and they have a lump sum and they want to make the money work a little bit harder for them, we're here to help them with that as well.
No, that's terrific, Owen. And even just looking at this example here, if that was, say, 12 months, and somebody puts 27 grand in, and they're up 27%. What you're talking about there is if you're managing that particular investment, they get the first 10%, and then you split 50-50 the 17%. Say it was a 27% return.
Yeah.
So you're looking at 10% and 17. 17 is 8.5. So the client is going to make 18.5%, and you make 7.5%. If I'm doing the sums right there.
Yeah.
So the thing is, the client makes the money first before you earn anything, basically.
Correct. Yeah.
Great stuff.
And just the one magical thing about this account, what you want really people to take home with them, is that if we scroll down here and look at the individual shares that this company owns, this club owns, that if you look at the shares, the blue box is what they paid for the shares, the orange box is the value now. So this company ECA has gone down, Kraft Heinz has gone down, Nokia has gone up ever so slightly, Pets has gone up ever so slightly, and US Steel has gone down. So the majority of their positions have actually dropped in value, yet their account has grown by 27%. Because we focus on two things, Declan. We focus on accumulation of assets, which is this blue line, generation of income, which is this green line. And sure, the value of the account is going to go up and down. But as long as you focus on income generation and you use that income to buy more assets and use the assets to generate more income, the account's going to grow regardless of what the share price does. So that's a very powerful thing for people to understand. It doesn't really matter long term what the shares do. It's all about the income and using the income to buy more assets and use the assets to generate more income.
And that's where the magic is. That's what most people on the planet don't understand. And this is the skill set that you have refined over 20 odd years here. So, Owen, I'd like to thank you very much for taking us through this here. Next step, call to action for anybody who wants more information.
Yeah, if you just get back in touch with Declan and tell Declan what you want to do. You either want to join an ordinary investment club where you put in a small amount every month and meet with us once a month to learn how to do it for yourself, or if you have a lump sum that's not really working that hard for you, go back in touch with Declan, and we'll we'll arrange to go into a bit more detail, give you a bit more understanding of how it works, and if you're comfortable, we can work with you on a one-on-one basis.
Excellent. Okay, Owen, thanks for your time there. Appreciate you taking
Declan.
some time out of your busy schedule there.
You're very
We'll
welcome.
catch up soon.
Take care. Look after yourself.
Thank you.
You're very welcome.